It's exciting to be here. So this is, I don't know how long, but more than 1 year and a half, I've been organizing S21 events. I'm one of the co-founders who are there doing like fugitive. So my name is Melissa. You know me as the blue face of the group. And I'm also a professional working in the field, building sustainable business strategies for startups. And what S21 is all about? Well, we're trying to build a community around the values crypto and blockchain for into our lives, especially non-financial properties, such as decentralization, community, self-sovereignty. And we're happy to observe many crypto professionals are coming out of the community. A lot of startups are building and all that. So happy to have you here. This is one of the biggest events so far. And this is our first event at the T-Hub, and we'll see if we're going to do it here. And so far it's very nice. You can share the feedback here. So I'm going to announce a couple of things quickly. First, I'm so happy that we just found a community moderator. She's going to do some stuff that I've been doing lately. They're super fun stuff like being annoying to do when there's unrelated crypto. So that's going to be fun. And the second point is that with the time that's spent for me, I will be doing like some other stuff that's going to hopefully bring more value to the community. We just had agreements, sort of soft agreements with two big blockchain events in Asia, one in Bali, one in Singapore. So the third point is please read the messages, especially the pinned ones, because there will be more things coming up, like the free tickets for these global conferences, for more networking and professional opportunities actually to just specifically for the group members. So that would help us a lot. So this is our actually second almost trading related talk we hosted so far. And the reason is they're all like coming from good academic backgrounds. And the first was Dandy with Bitfire, the Indonesian derivative exchange, and that was actually a community event as well. You can see it on our YouTube channel. So let's listen to Elliot and Sam. Thank you.
Hi everyone, my name is Elliot, and this is my partner Sam. We'll be giving you a presentation. So I want this to be like interactive. I don't want it to be like kind of like boring and seminar-like. But look, if you guys have any questions, something's not clear, ask away, okay? The floor is open. All right, so a little introductions about us. My name is Elliot. So I'm part of Systematic Trading Group with Dendi. He's the visionary behind it. My background, I did UCSB philosophy undergrad, and then after that, I did tax consulting. After that, I studied full stack web development at UC Berkeley Extension. And now I'm here in Bali living the dream. Yeah, I'll pass it off to Sam.
Hi everyone. So I'm Sam. I studied math, and I did studied machine learning, AI. Kind of got bored, and I joined this in November. So I've been writing like liquidation bots, basically the open source version of like liquidation bots. So not the kind of MEV where you get the P2P battle against other people and trying to get money. It's more like when protocols kind of open source, a basic version of the liquidation bots. So I was doing this for 3 days a week for AdvancedBlockchain. They just sacked me yesterday because of the bear market. So always good. Now we're going to be doing this full time and try to actually make money out of this. So hopefully it's going to be fun.
Yeah, feel free to ask away. By the way, the QR code, that is to our LinkedIn. Okay, so presentation order. Damn, that's a lot. Okay, but I'll start with the first half on the left. It's going to be more a high-level overview, and then we'll get deeper into it. That's when I'll pass it off to Sam. We'll take a quick break at step 3. All right, let's get into it. So what is MEV? I'll start with the first definition. It stands for minor extractable value. Now that refers to the max value that can be extracted from block production in addition to the standard block reward, right? The standard block reward on Ethereum is 2 Ether, and also miners get gas fees. So if you guys, I don't know if you guys know this, but basically when you guys put a transaction, it doesn't get immediately validated to the blockchain, it goes to the transaction pool. That's kind of a staging area, right? Now when it's in this staging area, it's visible to anyone and everyone. And while it's visible to anyone and everyone, people are looking for ways to maximize profits from there. All right, you good? Okay. By the way, I have like a slide on like key takeaways. I remember like looking at Investopedia, they have like a key takeaway section. I'm like, that's dope, I want to do that too. So I'll review like the high level stuff again. So this is the MEV opportunity. This is showing about Q1 of 2022. It's saying that MEV cumulative extracted gross profit was 634 million. And I would say this is the lower bound because this is what got captured by Flashbots. And continuing on that, here is a picture of Flashbots and transactions that have been made through MEV. I'll later go over the different types of MEV, but there's liquidation, there's also arbitrage. You can see on this side the gross profits and the cut to the miners. So MEV starts with a transaction pool, right? And that is first in, first out usually. But then it goes to the miners who have control over transaction ordering, they have control over exclusion, inclusion. With MEV, if it was ordered by arrival time, it would look like this Ethereum coin. Or without MEV. Now with MEV, it actually looks like this. So there's a lot of reordering that's happening. So I want to give like a real life example because like I'm like new to the technology world, so I understand things in like real world ways, right? So let's say I'm a real estate investor. I go golfing with some guy from Beaufort, Wyoming. He ends up being the governor, right? By the way, Beaufort, Wyoming, it's in the middle of nowhere, okay? It looks like that. The governor tells me, hey, I'm gonna have FANG companies come here, Facebook, Amazon, Netflix, Google. I'm gonna have nice hospitals, nice universities come and join this city. Me being the savvy real estate investor that I am, I buy some properties for dirt cheap, wait for the development to happen, and then I make a profit, right? So the same concept applies. Buy low, sell high in the MEV market too. So the evolution of MEV, right? It used to be called miner extractable value. That's because the context of proof of work. Miners had control of the inclusion, the ordering, the exclusion. But now, with proof of stake coming, it's turned to maximal or maximum extractable value. So who's involved? Who are the players in this? Player one, the searchers. These are people looking for MEV. They're creating bots to execute MEV opportunities instantly. You have the miners. These people receive gas fees from searchers and users, and they're validating transactions on the blockchain. And then you have the victims, the noobs who have no idea MEV exists, the poor souls. Now, types of MEV. First, we have decentralized exchange arbitrage. It goes into front-running, back-running, sandwich trading. I'll go into all of this in a little bit. And then we also have liquidations. That's on loan protocols. And then third, we have NFT MEV. Now, before I go on to the next slide, are you guys all familiar with arbitrage? So just in case anyone doesn't know, it's basically buying the same asset on two different markets, and there's going to be a price difference. You buy and sell on another market. So I go over DEX arbitrage here. You're going to buy, let's say, a digital asset on Uniswap and sell it on another DEX like SushiSwap. True story. One guy found had 1,000 ETH, turned it into 1,045 by selling it on Uniswap and buying it from SushiSwap, and there was an ETH DAI combo. So moving on to front running. Okay, so here's the transaction pool. It's in sequential order. You have the miners controlling actually where the transactions happen. You have transaction 3. This is what the user's transaction is. Now let's say user's transaction is worth a lot of money to the point where it's going to increase the price of the asset they're buying. I could pay the miner extra gas fees and get higher priority. So therefore, I would cut in front of him and then be able to get the same asset for a cheaper price. Now, back running is similar, but instead of being before, I'll come after. So let's say there's a situation where there's an initial release of a coin. I want to be able to get the list price, basically. So I would have a transaction come right after the initial release. So that's what backrunning bots do in the NFT market. And then sandwich attack, similar to the example, buy low, sell high, using the information that transaction 3 here is going to influence the price. So I want to give an example here. The market cap of Dogecoin is about 8 bill. Let's say Sam over here, he's a whale. He has a pending transaction in the transaction pool to purchase $1 billion worth of Dogecoin. Now that's about like 13%, right? So that's surely going to influence the price. I see that this transaction is in the transaction pool. I enter his transaction to buy Dogecoin. I pay higher gas fees, beat his transaction, basically front run it, and then he buys the transaction, and I realize Dogecoin has just shot up in price, and then I sell it after. That's an arbitrage opportunity in MEV. The next strategy is liquidations. Before going into liquidations, I'd like to go over the lending protocols. They basically allow users to lend and borrow assets. You have off, compound, and maker. But to borrow an asset, you also have to deposit collateral. So let's say I have 100 ETH. I want to borrow DAI stablecoin, right? On MakerDAO, hypothetically, let's say they allow me to borrow 50% of my collateral. So I get to borrow about 50 ETH worth of DAI, and that's about 58,000 DAI. Thank you. But ETH is volatile. The price is always moving. So what happens if ETH tanks? You could get under collateralized. So if ETH tanks due to market fluctuations, the value of the borrowed asset basically can't be more than 50% of the collateral. When that happens, the protocol allows people, liquidators, to liquidate that position, instantly paying off the lenders. Now these people make 5 to 15% in liquidation fees. So here's a story with this guy named Justin Sun. He's the CEO of BitTorrent. He founded Tron on the, which blockchain was it?
Tron blockchain.
Tron blockchain? Okay. Obviously I'm a noob if you guys know. Okay, but he had $1 billion position in a lending protocol, liquidity protocol. There wasn't a liquidation bot on it at the time, but for 2 minutes, he was under collateralized. If somebody had caught that, they would have made 5% of $1 billion. But he was able to fix it in the 2 minutes and it's clear. That's a lucky son of a bitch. Okay, so this graph shows the MEV opportunities by type. Majority of it is coming from arbitrage. Only a small percentage of it is coming from liquidations. And also, most of the income is actually going to the sender instead of the miner. The reason why I bring this up because later I'll talk about priority gas auctions and how miners receive a good amount of money. But you'll still realize at the end, the senders, the searchers, they still make majority of it. So NFT MEV. This is CryptoPunk actually, and I heard this popular story that a searcher basically was able to buy it at list price, buy all the CryptoPunks for $7 million. He bribed a miner so that his transaction was first in the priority queue and was able to buy it at list price, and then he made a ton of money after selling it for higher. But NFT transactions take place on the Ethereum blockchain, so MEV still exists. You could front run other buyers, but you could also optimize your gas use so you could outbid other buyers. I'll go into that a little bit too. Okay, these are the key takeaways that I want to send with you. MEV stands for maximum or maximal extractable value. Value from block production in addition to the standard block reward and gas fees. Searchers, player one in the MEV world, okay? They're looking for MEV. And then types of MEV, you have front run, back run, sandwich attack, you have liquidations, and NFT MEV. All right, I want to pause right here, read the floor, like, any questions? Let's go.
So the DEXs, with like the front running and the back running, do they put a lot of effort into countermeasures to stop people doing that?
Yeah, so Sam's going to go into it in deeper depth, but yeah, there are countermeasures in place to prevent front running and back running. They're called flash bots, and basically the transaction pool is transparent, but there are ways to make it anonymous.
So that's like at the infrastructure level, right? But at the protocol level, you just have slippage tolerance. Right? So when you're on like UX, you just choose like, I'll accept like whatever 1% slippage, like extra of like the AMM slippage. And then basically that just means the bots are allowed to, steal like 1% of your value. So you can play with that.
Just Ethereum blockchain, or is it also for Solana and other blockchains?
It exists on other blockchains as well. Yeah.
That's a good question. So basically the game is like extremely different on different blockchains, right? So the MEV game on Ethereum is like way further ahead of like other blockchains because it's been there for a long time. Yeah, exactly. And then on Solana, there's a lot of crazy stuff happening, right? Because it's just fast and transaction fee is like super low. So yeah, the game is super different. There's different kinds of, like basically, people coming from the high frequency trading world, like hedge funds, are more on Solana because it's kind of the same way in some sense. It's like first in, first out. Whereas here, it's much more like gas related and transaction pool related. So it's just different worlds, different stuff.
Oh, what's going on there?
Do I need it? Or?
Yeah.
I don't think it's really working.
I don't know if it's working
It's not
either.
really working.
That's the
Okay, thank you.
So right now we are in a bear market, but let's face it, we actually have evolved as an industry in crypto from back in 2017, 2018. To what extent now you can make the same profits that you would make when the market was not as efficient as it is today? I suppose that now there are more participants that want to extract these profits from the table. So is that limiting your potential in terms of what you can extract from each block?
So you mean as like an individual MEV searcher? Right?
The more efficient that a market becomes, the less share of the pie goes to one single individual. So
Right.
what's the state of affairs on that front?
Exactly. So your question is basically like, it depends if you're targeting an individual like me or like a hedge fund. So basically already it has consolidated and there's
Yeah.
like super vertically integrated, and then people who are doing MEV usually will just like on proof of stake blockchains, for example, Avalanche, they just have like 100 million stake so that they control 20% of the hash rate, and then basically they can just like put the transaction that they want, right? So that's a big problem that we will touch into. The question is like nowadays basically you need a team. Like there's no way. Yeah.
So it's just a follow-up. Which metrics is it correlated with in terms of the market dynamics? Usually the efficiency of the underlying value. Is there any study that is correlated with?
I don't have the
Still stuff after.
I don't know. Does anyone have a clue?
I just have a question.
First of all, excellent presentation so far. It's so nice to see a technical presentation for a change. I'm sure you know about the history of first seen, first committed, the promise intimated by Satoshi back in the day, but never really realized because there's no game theoretical assurances for it. And then Peter Todd, with his replaced by fee, kind of like made things a lot worse. Can you comment about time chain technologies that are not based on blocks, so directed acyclic graphs that purport to have game theoretical assurances for first seen, first committed? Do they actually reduce MEV in any mathematically measurable sense?
I'm gonna have to defer to Sam on that one.
Okay, so which block you're referring to? Avalanche?
They seem to purport to have game theoretical assurances for first seen, first committed. Is that true, or is it all yes?
You're saying like the mempool, I mean, just first in, first out instead of being Avalanche, definitely not. Definitely not. Basically, Avalanche, if you want to have access to the mempool, you need to be a staker. I think you need to. I forget. It's like a ridiculous amount of money. No.
Okay.
And we're gonna come back to this, but yeah, your question is like also added. That's a little, but We'll come back to this. We'll see.
There we go. Okay, so I think most of you guys are familiar with gas fees. The user fees paid to miners for compute and storage, right? Because of this, we're able to process and validate transactions on the blockchain. Now, the unit of measurement for gas prices, we know it in Gwei. 1 ether equals 1 billion Gwei. Now, to calculate gas fees, it's a simple formula. Gas fees equals gas used. Now, this is optimizable. That's very important because, alluding to your question, it makes things more competitive. The people who are better at optimizing are more likely to win. Times gas price, which is base fee plus tip. Now, base fee is set by the market. The tip is set by the user. So an example, Sam transfers 3 ETH to me, Elliot, at 60 Gwei gas price. A basic transfer is 21,000 Gwei. The number of ETH here doesn't actually matter. So let's say it's 1,000 ETH, it'll still be 21,000 gas used. But let's say it's a smart contract, something much more complex and CPU intensive, then it's gonna be significantly more. And the interesting thing is that Sam and I can both have a smart contract that does the same exact output. But there are ways that I can optimize it so the amount of gas used is smaller for me. But going back to this example, it's going to be 21,000 gas used times 60 gas price equals 1,260,000 Gwei, which is 0.00126 E. Now, since users can set the gas price, miners prioritize their transactions or the transactions with higher gas prices faster. There we go. So bottom line is, if you want faster execution, higher priority on the blockchain, pay more gas. There's an option to pay more gas and get higher priority on the blockchain. You have priority gas auctions. So over here you have transaction A is greater than transaction B in terms of gas fees. It doesn't matter if transaction B was actually first in terms of arrival time. The miner's going to choose transaction A's first because he's going to get paid out more. So one of the objectives of the searcher is to get transaction priority on the blockchain, right? That's how you front run. So to get higher priority, searchers are competing against each other by bidding up the gas fees. So here's an example of two bots going through PGA. They're constantly sending bids. It's a race to send bids. And they're outbidding each other constantly the whole time. Over here we have a winner, but they continue to still bid each other because I think it takes time for them to find out who the winner is. But you'll see it's very competitive. Now, if you had 20 bots competing, this is going to drive up the gas price. So sometimes it's not beneficial for the user or the searcher. So from a searcher point of view, if you use Ethereum, yes, it costs everything, okay? But take this with a grain of salt because searchers still get paid a good amount. You saw in the graph earlier, only a smaller portion of the money goes to the miners. Okay, so Bali, like, I've been to Vegas and I've been to like big cities. I think the dating scene in Bali is probably the craziest that I've ever seen, right? So I want to create actually an auction here, okay? So I see a bunch of handsome gentlemen here. I'm pretty sure they have like 3 or 4 Tinder girls lined up in their profile, right? So I actually have a bouquet of flowers. Dendi, what's the value of that bouquet?
100K.
So the value of that bouquet is 100K. Who's got a date today or who's got a special someone they'd like to give this bouquet to? And I want to create an auction. I'll start the floor at 50K. Okay, 50K? 100? No, whoa, okay. 1 million? Okay, look. I don't see a girl next to you. Let's give it to this gentleman. Okay, look. Let's put it in, okay? That was a terrible auction situation because you went too high. But I'll give it to you, okay? You're lucky you got a beautiful girl next to you. But that was a little gift from the Indian Systematic Trading Group, okay?
That's actually hilarious because that's like an NFT basically auction. It's just you don't overprice something.
Okay. So who knows who this guy is? No one's from America, huh? If you guys were from America, you learned this in high school. But this guy's Andrew Carnegie. He's a founding father of American industrialism. Inflation adjusted, currently, his net worth is $310 billion. He is famous for being super stingy and cutting costs, right? The reason I bring that up is because if you want to be really good at MEV, you have to minimize the gas use cost, right? So for transaction priority, searchers are paying gas fees with tip, but this is cutting into MEV profits. Now to maximize those profits, searchers are using something called gas golfing. Gas golfing, it's basically optimizing transactions to minimize gas use. So as I mentioned earlier, you have two smart contracts doing the same exact thing, but I can do something to my smart contract to optimize it and actually have less gas used, and therefore more of my transactions will enter the blockchain. So if you want to get really good at MEV, the key is to get really good at gas golfing. Now, this is what a good searcher will do, right? A smart searcher will do some gas golfing. Let's say searchers can spend up to 10 million in gas fees for a profitable MEV transaction, right? So 50,000 gas fees for the smart searcher. You have the 20 base fee, which is set by the market, plus 180 tip. Now the noob searcher, he's using 100,000 gas used. 20 base fee set by the market plus 80 tip, right? This person can have double the amount of transactions in the blockchain because they're using less gas used, therefore increasing their chances of winning the MEV opportunity. So key takeaways here, you have priority gas auctions, exemplified by the gentleman who just bought the flower. And then searchers bidding against each other and paying more tip and gas fees so their transaction gets priority. And you also have gas optimization or gas golfing. They're searchers looking to minimize gas use by optimizing their contracts or transactions. All right, I'm gonna pause right here. Any questions? Yeah?
So this will be applicable till ETH.2 comes out. So if you're like, and then what happens if it's more stable and the gas wars are not so high anymore?
Okay, first of all, thank you for asking questions. This is really fun. Yeah, there's still going to be MEV, and nothing's going to change. ETH 2.0. The game's going to change. Like the infrastructure is going to change. People are already creating things. But your question is related to: is PGA, is the golf battles on the mempool going to disappear? So, should I stay here? I'll disappear in a second. Basically, the golf battles disappeared when Flashbots created their product, right? So now all of the auction is like a closed bid system out of the mempool, so you don't even see them. So there's no more PGA. PGA is like a thing in the past. It's a thing on Polygon. It's a thing on all the other chains, but not on Ethereum. So that answers the question.
Not really, that, but
No, I think, because ETH.2 will actually stabilize the gas costs, and the gas costs will be very, very low or lower. And so then there's no too much need for this product MAB. Am I right?
sorry.
No, it's a really good question. So, okay, MEV is not a product, right? It's like not the...
Whatever,
whatever it's called, yeah. So you're talking about roll-ups, right? Once the kind of state and all the transactions go to roll-ups.
Yeah.
Actually, it's going to be even worse, because then the thing that happens is when you have a cross-chain scenario, it's less of like an open bid system where anyone can enter. Basically, the producers of the different rollups, if you can control like 20% of the hash rate on different rollups, then you can kind of align those, and at some point you'll be able to extract like the cross MEV extraction, right? Which is it's going to be like impossible for anyone other than the people who have already a shit ton of money in stake and who are controlling like the mining power.
Okay.
Yeah. So. I will get back to this, but right now there's like a lot of, it's like the perfect question that's going to be a segue to like another, ETH 2.0 is in the presentation. But,
yeah, okay, thank you.
So I have an anecdotal example that I wanted some explanation for. It's been back on my mind for a while. Are you familiar with the Bancor ICO?
sort of.
Not the Bancor, sorry, the BAT ICO. The Basic Attention Token ICO. It's the creator of JavaScript. It lasts for 45 seconds.
I'm not.
You're familiar with that, though? Okay, anyway, so what happened was they published their ICO contract a day before the ICO happened. And then they also published their recommended gas limit. right? So one of the things I did was I cloned the contract and tried to see how much that gas limit how much the real gas limit was, and it was lower than what they had sort of prescribed. I was lucky enough to actually get into that ICO, and I think the only reason was because I put the lowest amount of gas limit that my cloned contract accepted. But my gas price wasn't that high. There were people that would put really high gas prices and they got preference. Do you know why that worked? Do you know why my contract got in, my transaction got in, even though I didn't put a really big gas price, but I put a low gas limit? It seems game theoretically unintuitive for the miners to accept my transaction. Do you have any clue why that went in?
Yeah, no, it doesn't really make sense because basically gas limit, like, you could put like a gazillion, right? And it doesn't matter because you'll get refunded the difference. It's the only parameter that matters is the gas price. So what is this contract? Is it your contract or is it their contract?
No, it's their ICO contract that they published the day before.
I see.
I just cloned it and tried many different gas limits, and then I figured out that you actually didn't need the gas limit. They were recommending to everybody to participate in the ICO.
Yeah, I'd be curious. We can chat after. I'd be curious about from this they're missing information.
Okay, we're going to be switching gears a little bit. I'm going to be doing a comparison of CeFi and DeFi. Basically, there are parallels between the centralized finance or traditional finance world and the decentralized finance world. So MEV-like opportunities, they exist in both CeFi and DeFi, right? People will always look for ways to game the system. And one of the parallels that they share, it's a game of speed, right? So in CeFi, you have latency games. There's co-location, high-frequency trading. If you guys read Flash Boys, they talk about that. And then you also have decentralized finance version of the game of speed with priority gas auctions. So the latency games that exist in high-frequency trading, right? The objective of the game is to have the fastest execution speeds because you'll get information faster. You'll be able to go to the exchange faster. For example, in Flashboards, they talk about in the first chapter a company called Spread Networks that was trying to get a line from Chicago to New Jersey, and Verizon would take them 17 milliseconds. By the way, it takes 100 milliseconds to blink your eyes, so this is like super fast. But Spread Networks was doing it in 12.5 milliseconds, selling it to these high-frequency trading firms, right? They would charge them 10 million a pop to be on the line. So speed really matters in the CeFi world as well. Another strategy to get speed so that you get information faster or send information faster is co-location. Basically, you want your servers hosted in the same physical premises as the exchange's servers, right? And you pay a premium to be in that physical location. You pay even more premium to have your server closer to the exchange's servers in the building. So latency games exist in both areas. Now, priority gas auctions, they're doing the same thing. They're bidding against each other, constantly racing to get the higher bid. And it's still a game of speed. And the person who's faster at the race, they're more likely to win. Now, the second parallel is with visibility. This is what you brought up, actually. So this is something to protect the users. You have dark pools and flash bots, right? So in dark pools in traditional finance, basically these buy institutions would want to buy huge positions, right? But people would be able to front run them because they're on public exchanges. So came the creation of dark pools to create anonymity, to create anonymous transactions, and it's more opaque instead of transparent. So people were able to do huge volumes of trades without being front run. So basically, dark pools are private asset exchanges designed for liquidity and anonymity. I have a hard time saying that word, but large positions are protected from front running, right? The thing is that it creates cheaper fees. There's less transparency. There's less risk of devaluation, but there's chances of unethical investment practices because these dark pools, they're created by private assets and they have access to that information first. So it could be a double-edged sword. Now, flash bots, I'm just going to say this one line because Sam's going to go into it at depth, but it's basically the DeFi version of dark pools, right? You connect users directly to the miners and allow them to avoid the transaction pool, that mempool where it's fully transparent and arbitragers and MEV searchers exist.
Actually, I don't think I get into this like in a lot of details. Maybe is flashbots like? Do people understand flashbots? Just go for it. Go.
Yeah. Okay. Are flashbots clear? This is like fairly new, right? Like this is a new organization basically trying to help the users.
Yeah. I don't have people heard of flashbots. Is that a thing, or when you say that?
Okay. You guys have any questions about flashbots? Basically, if you want protection from MEV, it's good to get connected with flashbots.
Anyone who wants more information, Chico Crypto is on YouTube.
Chico Crypto. Okay. More information about flashbots by Chico Crypto.
I was just going to say, flashbots for MEV protection. It's just basically a setting that you can put in MetaMask, update the RPC, then you can start using flashbots to just protect against MEV. There's some technical trade-offs or trade-offs where if your transaction fails, you can probably speak better than that for what happens if you don't get refunded your rate.
I don't know, this might not be necessary, but I still kind of just want to make it clear. Basically, the set of miners is just a distributed system, right? So you use proof of work or proof of stake to decide basically who gets the right on that ledger next. So then the problem is you have this mempool with like full of transactions, and everyone has access to it, right? Like because it's kind of the point of the mempool. So then you read from it, you have all these transactions, and you can kind of pick and choose which ones you want to include. Flashbots, what they did is they just created this kind of private relay, so it's kind of bringing back to Web 2, but there's lots of good reasons for this. So basically you send your transaction, instead of sending it to the mempool, everyone can see them, you send it, as he said, like you can protect your transaction by sending them to this private relay, and then they will relay them to miners, but the miners use this like Ford software of Geth, which has, basically it doesn't put those transactions in the mempool, so it's like a private mempool. So the point is now your transactions are hidden. It was a problem in the beginning when these miners only had maybe like 10% or 20% of the miners were running flashbots, because then it takes, like 5 times as long to get your transaction included. But now flashbots, I think 90% or so of the miners are running this software. So basically do not hesitate to use this. It's the way to go.
Okay, so going on to the last characteristic that they both share is ownership, right? So you have payment for order flow on the CeFi side, and you have miner search or collusion. So this isn't exactly the best situation for the end user, right? You have to give up some control of your transaction to somebody else. In this case, my example, I have Robinhood and Citadel. In this case, in the DeFi world, you have miners and searchers who have control over your transaction. So payment for order flow, right? It's the compensation the brokerage firm receives for directing orders for trade execution to a particular market maker. So you have Citadel, a market maker, and you have Robinhood, a commission-free investment app, right? So Robinhood connects buyers and sellers. Let's say I want to buy 200 of Disney stock, and Sam is also a seller, but what's the likelihood that he has 200 Disney stock at the same exact time I want to buy? It's unlikely. So to create liquidity, they give the transaction to Citadel. Citadel will be able to execute that trade immediately, but Citadel pays a little kickback to Robinhood in payment for order flow for sending all these trades to Citadel. So this is a little bit of a controversial situation because Robinhood has a job to give you the best execution price, but the problem is that they're also a profit generating company and they want to maximize profit. So maybe they get payment for order flow at a higher price with somebody else or somewhere else, and they're not going to care as much about the end user. Miner search or collusion, similar to Citadel and Robinhood, you have two parties who are looking out for their own interest over the end users. They have ownership over our transactions. This creates risk for us, right? They have the power to order to exclude transactions. So there's a lot of risk on the user end, but Sam will go into some protective measures, and that is the end of my presentation. We're going to take a 15-minute break.